Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are talking rates, and those 10-year note yields keep creeping higher, extending the range up as high as almost 280 today. Recall not too long ago we were talking about a 10-year note yield range of between 220 and 240, and it just seemed like we were stuck there forever. Now we've really seen a breakout move. As we've hit 2018, we've hit a Fed that's talking about being more hawkish, more cautious about inflation, higher rates in the short end, and it's now starting to feed back into the long end despite the fact that the curve remains historically flat. We could start to see that change in the meantime as we continue to see the back end of the curve bump up yields. And what has that done to implied volatility? Well, implied volatility it's up week over week, but it seems to be kind of cautiously waiting for that employment number tomorrow, as well as other data we have coming out next month. So while implied volatility remains low on a historic basis, it is higher, and that's a good thing. That means we'll probably continue to see yields go higher as that becomes a breakout trade as we near 3%. 3% seems to be a target, and there's a bullseye on it for 10-year note yields. So as we get to that, I think that was probably a level that was not foreseen in the beginning of the year and going back into the middle and late part of 2017. So now we're getting there, and the market's kind of starting to absorb the fact that this is a reality and not just a hope trade. And as we head into Friday, well, we have the employment data, the big number from January that'll come out 7:30 in Chicago time tomorrow. We are expecting a stronger number from December, which I think, from the November reading. So I think that right now that is playing into this. We had a very strong ADP number earlier in the week. That could probably help us nudge those numbers up and probably maintain this trend. I don't think that employment will be the reason why we push yields extremely higher, but it could be a reason why we back off if the number comes in very weak. Likewise, we'll be looking at those average hourly earnings to continue to creep up, and that in itself will be an inflation gauge that the Fed has wanted to go higher. And while it's starting to turn a little bit, it still isn't, I think, at the level that the Federal Reserve and policymakers in Washington are expecting or hoping for, and we'll get a reading on that for the month of January. So right now, 10-year note yields really seeing a strong push higher, trending higher. Volatility's higher, which means we'll probably continue to see this breakout move, but it all could change tomorrow on employment if the numbers don't come in as expected. So I'd be cautiously optimistic that we'll see a strong number tomorrow, but wait and see. Things could change on a dime. This is Todd Colvin coming to you from the floor of the CME Group.